Hello, welcome to this week's How's the Market, Pensacola. Well, I'm going to shut some of this nonsense down this week. This episode may be a little spicy, maybe a little longer, but I'm tired of all the nonsense that's floating out around there. I'm tired of getting on social media, getting on whatever, and people telling me all kinds of misinformation out there about what's going on with the real estate market. So I'm going to shut it down. I'm going to shut it down. It might be a little spicy this episode. All right, I'm kind of in that mood today. I kind of made it a little spicy. So let's just jump straight in. I'm going to talk about what everyone's talking about when it comes to the real estate market. We're going to talk about inflation. We're going to talk about foreclosures. We're going to talk about forbearance. I'm going to show you statistics. I'm going to show you data so that we can shut it down. All the misinformation out there. Let's talk about what's really happening and how it impacts you in the real estate market here along the Gulf Coast. Let's jump straight in. I'm going to share a couple of slides with you because it's not just me coming up with this data. This is not just an idea that I have. No, I do my research. So I'm going to show you data. You can make your own decision at that point, but here's the data. All right. First slide. Look, foreclosure activity. Everybody said, hey, we're going to have another foreclosure crash. We're going to have another foreclosure crash. Shut up. Look at this year-end report last year. We are at the lowest we have been for a while. What was it, 2005? Even during the boom, if you remember, 2005 was a real estate boom. We were booming. We still had 533,000 foreclosures filed. Now think about that. It was so easy. Everything was, in that particular moment, people were investing in real estate. They were investing in builder stuff, right? A builder would come out and announce a neighborhood. People would go in and buy the first one just to rent them out for the 3 years while the builder continued to raise prices so they could sell them when the builder finished the project. So 600, 700, even 300 unit developments. People would come in and buy the first one. I know some investors when I worked down in South Florida that would literally come in, buy the first home, rent it back to the developer for the 3 years to use as the model, right? And then at the end, they would sell the model because the appreciation happened. But look, if you look at this slide, 533,000 foreclosures were filed that year. What were filed last year? 151. Q1 of 2022, we got 78, so that's half. So let's go from 151 to, let's say, 200 and something. That's still 50% lower than what it was in 2005. So foreclosures are at an all-time low. I don't know where everybody's thinking we're getting this new foreclosure boom going to happen. It's just not there. None of the data points to that. Oh, it's easy to scare. It's real easy to scare people, especially with headlines and inflation. And people think that because we say the word recession, that we're automatically going to see a price reduction in real estate, that real estate's going to go down. I have said this over and over and over again. The last 5 recessions, 4 of them real estate went up. It was just the last one that real estate went down. And everybody's like, well, I still have PTSD from what happened in 2008, 2009. First of all, you don't have PTSD. Let's get that very clear. All right. Matter of fact, I looked it up. Right there. This is the book that therapists, psychologists use in order to diagnose. I'm not a therapist. I'm not a licensed psychologist. I'm not trying to diagnose anybody. Let me get all that legal mumbo jumbo out. I don't think anybody thinks I'm a psychologist or a therapist. But I do know the book. Right? And I looked up the definition. In order to have PTSD, you have to have been exposed to actual or threatened death, serious injury, or sexual violence. A foreclosure does not fall up under that. Ladies and gentlemen, I had a foreclosure. I lost my home. You can't claim that anymore. So stop it. Stop it. It's time to get past all that. If you hadn't seen the movie this past weekend, what was the number one movie at the box office? Number one for a while was Top Gun, the Maverick one. And what was one of the main issues? It's time to let go. I'm not going to ruin the movie for anybody who hadn't seen it. If you hadn't seen it, go see it. All right, it's a good movie. At least I thought so. But it's time to let go. It's time to let go of that mentality. That knee-jerk, hey, we're going to see a recession. We see high inflation. Prices are going to reduce. I'm going to show you that that's not the case. It starts with this right here. Foreclosures are at an all-time low. Let's move on to the next one. Forbearance. Oh, there's that forbearance word. They edge downward. All right. Look at this. If you look, May 2020, it's when all this COVID stuff hit, right? We had a lot of forbearance numbers, but we've been steadily going down since. And the people that are coming out of forbearance, some have caught up. The majority have had a workout program. I saw a statistic the other day. I couldn't find a slide for it, but I saw a statistic the other day that said over 58% of the people come out of forbearance just did a workout, with 30 some odd percent just paying what was forbearanced. Meaning, you know what, we didn't pay at the time, but here you go. Here's the 30 grand, 40 grand, 50 grand, 80 grand, whatever it was, right? We'll just catch up. So that leaves a very small percentage that are still in forbearance. Look at this. This is data. Make your decision the way you want to. All right. Lending standards. We always go back to, hey, it's 2000s. It's 2008 all over again. We're going to see this huge crash. We're going to come down 19% like we saw in 2010. But look at your lending standards right now. This is why I keep telling folks that's just not the case. It's not the case. Lending standards since early 2000s. Look at your product risk and look at your borrower risk. Risk. I'm spicy, I'm telling you. I'm just, right. The product risk, and I remember some of these products in 2005. I remember when people came to me for me to buy money from them. I owned a mortgage company at the time, so I would buy money from people and then sell it to the public. That's what I did. Right? I bought it wholesale, sold it retail. It's just like any other product. I just bought money. But I remember some of the products they brought to me. 125% of the purchase price with no verification of anything. What they call a no documentation loan. So if you pulled a credit report and it said 720, they said you obviously pay your bills. We don't have to document anything. And we'll give you 125%. And so you're buying a $200,000 house. That's what, $250,000? We'll give you $250,000. Why? Because real estate constantly goes up. So the product risk continued to rise. Look what's happened since then. Look where we are now. Look at the slide now. There's hardly any product risk, and the borrower risk, I cannot say that word for some reason, is way down from where we were. So how could you possibly say we're going to have the same outcome when we've done something differently? Here's your lending standards. These are the volumes of loans with people under a 620 credit score. Do some of those still exist? Sure. Sure, some of them still exist. Do they have a place in the marketplace? Absolutely they do. I can't tell you how many loans I did under 620 because there was a bad divorce case and people stopped paying out of just spite, right? They could pay. They had the financial ability to pay. Or there was a huge medical thing, which they're supposed to be pulling off now, but it dropped the score down below 620. Do they have the place in today's marketplace? Sure, but nowhere near the volume that it was in 2007, 6, 5 that was building up to the crash. So the landscape is drastically different. We cannot say we're going to have another crash when the landscape's totally different. Totally different. Let's talk about what all the experts, all the economists are talking about appreciation-wise for the next 5 years, 4 years, 5 years. This says cumulative house appreciation by 2026. Your optimists are almost 50%, 46.5%. That means that you have gained 46.5% appreciation in the next 5 years. Now your pessimists are saying you're only going to gain 10 over the next 4 to 5 years. So what's that, 2.5% a year? What do we call that? A normal market. People are spoiled with these double-digit returns. And they're saying if we don't get those, then we're crashing. That is not the case. Stop it. This is what the economists are calling for the next couple of years as far as appreciation. This is your averages. They're saying we're going to be at 9% this year. And I'm going to show you in the next slide where we're getting that 9%. I think we're going to be slightly over. I think Fannie and Freddie think they're going to be over. They've got a better finger on the pulse than some of the others. The Mortgage Bankers Association is thinking we're at like 6. Fannie and Freddie are talking low double digits. I think here in the Panhandle, we're probably going to be those low double digits again. All right, which is going to give us 3-4 years now of double-digit returns. So can that sustain at double digits? Probably not. But does that mean we're going down? No, it doesn't. So stop it. I don't know why people are sitting on so much cash waiting for this crash to happen. I understand the buyer frustration with, hey, we've had to put in a lot of offers and we haven't won. I get that. That's a different conversation. But people telling me I had somebody tell me they have $750,000 cash waiting for the crash. I wanted to punch them in the throat. Just what I want to do. Because if you want to talk about inflationary issues, if inflation's 8% and that savings account that you got is paying you under 1%, you are losing money. You are losing money. We're not even going to go into the tax benefits of depreciation, recapitalization, all that other stuff. I'm not going to talk about all that. I'm just going to talk about if you're doing that. And they're like, no, it's going to crash. It's going to crash. It's going to come down. This guy told me it was going to come down 50%. I asked him to show me what he was reading. I said, show me what you're reading. Nothing. The conversation ended. It was just one of those, hey, you're a realtor, Shane. You're a real estate broker, so your job is to promote real estate. No, my job is to be an advisor. I've told plenty of people don't sell. Just had a client conversation last week. Guy said, look, here's my decisions and this is what I'm looking at doing. I'm like, then you don't need to sell. You need to rent the place out until that decision is made. You have time. What are your tax consequences? Well, I'm not a CPA. All these disclosures I have to give on this episode. I'm not a CPA, so I can't tell you that. But I can tell you this is what you're looking at. We went through, and I told him, no, don't sell. You can't sell. You're not allowed to sell. Of course, he kind of laughed and went, I'm not allowed to sell? I'm like, nope, you're not allowed to sell. You're a client of mine. You're not allowed to sell. Hold it. That's for this decision. That's what you need to do. Now, 2 days later, I was talking with a different customer, and they're like, I'm thinking about renting it out. I'm like, okay, what do you plan on doing? We walk through, and I'm like, you may be better off selling because you need to reallocate your capital. That's a difference between being just a realtor opening a door going, look at the color of the cabinets, versus being a real estate advisor, which is what I say I am. There's a huge difference. Let's get back to the slides. Home price forecast. Where did I come up with those numbers? Where did I come up with that 9%? It's the average. So Fannie Mae and Freddie Mac say we're going to be double digits. CoreLogic, NAR. MBA is the lowest, saying we're going to be at 6.2% appreciation this year. 6.2%. So why would you sell? What is the point in selling right now if we're going to continue to see appreciation? Well, because we can reallocate capital to other things, and there's other aspects. There are tax plays that need to be considered. Some people have some serious equity. I talked with a matter of fact, I helped the customer sell not too long ago because they were getting stationed somewhere else. And their thought was, hey, can we just rent it out? I'm like, you can, sure. But then they looked at their debt and their overall financial picture. When you look at the overall financial picture, the 100,000 plus, 6 figures from 4 years ago, 6-figure plus capital that you can take because you lived in your home for the last 2 out of the last 5 years, and you can take it without a tax implication now and handle some of the other debt. It made a whole lot more sense for them to sell. But that is situational. So, I'm going on there, but that's where that 9% is coming from, right? I really wanted to bring this slide in because I have people say, buyers especially, well, what happens if I buy and it goes down? Some of my best investors bought in 2006, 7, and 8. Investment properties. They bought them. Had no intentions of selling them. So if the value goes down and you don't sell, who cares? It's time to let go. It's time to let go of your preconceived notions. Who cares? The rent's gone up, right? The place was covering itself when we bought it. We bought it right to where you were cash flowing. And even with the increase in insurance and the increase in taxes that all of us investors are seeing, the rents have superseded that. So who cares? You're only going to lose money if you sold in 2010 or 11. That was a huge epiphany to me because I was in that dark place. I was in the dark place where I had just lost my home. I was in a dark place where my home had been foreclosed on. All my investment properties had either been short sold or foreclosed on. My capital was dwindling quickly. My income had dropped 90 some odd %. So I understand. And I was like, oh, I don't know this is the right game. And that one investor looked at me and was like, Shane, let's talk. We went for coffee and he explained a lot to me. I say clients teach me. That's just called experience. That's all that is. Look at this slide. Even if you held in 2006 and you just held through the drop, where are you at now? So let's say that I'm completely wrong. You bought something now and it drops. What do you think is going to happen in 2031? 2035? We might have to look at this as a little bit longer play. I don't know this is going to be your forever home. I've heard that term a lot lately. This is my forever home. Okay. If that's what you believe, cool. I don't think I'm living in my forever home right now. I love my home. I think it's a great place. I don't think I'm living in my forever home right now. So you might need to say, instead of every 3 or 4 years, if it did, which we're pointing to everything that says it's not going to, but if it did, if I was wrong and you bought and the prices went down, as long as you have a longer term, you're fine. Who cares? Who cares? If it's your home and you put it on a 30-year fixed and your rates are in the 5s now, right? They were in the 3s a few weeks ago. Now they're in the 5s. Okay. We're probably going to float in the 5s. We may touch 6 this year, but I don't know. But as long as we're right there, then your payment is not going to adjust much. It may adjust some for insurance. It may adjust some for taxes, but it's not going to adjust much. And if you were okay with that and we just hold long term, just hold. Cool. Then we're fine. There's no problems with it. Are there times to sell? Sure. Are there times to sell to take a loss? Absolutely. I know that was, let me say that again, because some people are going to go, did he just say? Yes, I did. Are there times to sell and take a loss? Absolutely. I've had some people take a loss on property. Now, this was in 2011, but they took the loss on the property because they had a gain on something else so much that they needed to equate it out, or else they were going to have a huge tax liability. That's a consideration. That's a difference between a realtor and a real estate advisor. That's a consideration. But look at this slide right here. I mean, yeah, okay. If it dropped a little, just hold. You're fine. You got to buy right. You got to buy right. All right. Last slide. I did want to bring this up because I always try and bring up the opposite side of my argument. All right. And this is going to actually show when we get over to Escambia and Santa Rosa County. I'm going to prove this slide as soon as we get over there. So the average consumer is spending an additional $429 monthly on items other than shelter, meaning gas. You seen gas prices lately? Food. What the heck's the cost of a banana? Right? Some of these are other. So they're spending on average $429 monthly higher, but they're only making $212 more a month. So that leaves them with a $217 a month deficit. Okay? Gas prices. This means the average consumer is going to be looking for a home that's $41,793 cheaper. That's pretty specific. Yeah, it is. It's real specific. But that's an advisor for you, right? That's an advisor. So $41,000 cheaper. So our higher end stuff, is it going to maybe move out of that hyper sellers into a sellers and maybe even a neutral? Well, let's see. Let's take a look at our 2 counties right now and see if this actually makes sense. Let's go. All right, for those of you who have never seen this show, you don't know that I always start with this slide right here. It says if we have between 6 and 7 months worth of inventory, we have what's called a neutral market. Anything greater than 7 months considered a buyer's market. Anything less than 6 months considered a seller's market. What the slide doesn't say is anything greater than 9 months considered a hyper buyer's market. Anything less than 3 considered a hyper seller's. Let's start off in Escambia County and look at what we have here. There's nothing under $50,000. We do have 505 active right now, so we are definitely in the spring buying moment. All right, but what did that slide say? Let me pull that slide back up. That means they're going to be buying less. They're looking for something cheaper, right? If we go there, they're looking for something cheaper. Well, the cheaper stuff has still got $100,000 to $150,000 is 0.8 months. $150,000 to $200,000, 0.5 months. 200,000, 250,000, 0.5 months. Then we get up here to the 350 to 400,000, 1.4 months. That's triple what it is below, but I can say triple, and we're still at 1.4. We're still well into the hyper sellers market. Well, what do we have here? 550,000 to 600,000. We're at 3. Now that's been a pocket here for a few weeks now. We're at 3 months, but look at this: 650,000 to 700,000, 5.2. You're almost at a neutral market. Would my marketing change if I brought something on between 650 and 700? Absolutely. You're not in a hyper sellers market there. You got to differentiate. What do we do different? 700,000, your luxury, 3.1. We've come out of the hyper sellers into a sellers. Would my marketing change here? Probably not. I would probably still treat this 3.1 as a hyper sellers when it comes to marketing because it's just so close. But that 5.2, that makes a difference. So if you're coming on this week, then you need to make that decision. You need to make your changes. All right, this is the data that shows that. Let's jump over to Santa Rosa County. This really proves my point. Nothing under 50,000, one property under 100,000, nothing under 150,000. Yellow. So under $150,000 total, we got one. 330 total active, so we have increased inventory there. But look, just what I was saying, that people are going to be looking for stuff cheaper. You get down here to 600,000 plus, you're out of the hyper sellers market, you're into a sellers. So, I know, it's a lot longer show than normal. All right, I normally don't go 20 minutes. Most of my shows are 10, 12, maybe 15 minutes, but we're well over 20 minutes now. And so I wanted to just show you some data, prove some of this misinformation out there as misinformation so that you can make good decisions. Would you sell in this marketplace? That is situational. You need to talk to someone who's going to advise and not just tell you absolutely. There are more realtors than there are properties listed, which means a lot of people, and I'm not going to talk about cohorts, but I have heard people saying, you need to sell, you need to sell, you need to sell, just because they need work. I know that's tough to say, but they need work. That's not why I'm here. All right, I've been here almost 30 years now. So I've seen this. I can tell you from experience, we are not 2008 again, 2009 again. We're not. And I just showed you all that. So there's all the data for you to make that decision. Will marketing change? Yeah. Should you sell now? That's situational. If it makes sense, absolutely. Some of my investors are really calling. We're going over inventories. We're going over portfolios. We're taking a look at, okay, what can we rent and what can we pick up if we did sell? There's something that the current president was talking about trying to do away with, and that's a 1031 exchange, but that hasn't happened yet. So people are taking advantage of that. They've got a lot of equity and they're moving into something different that increases cash flow. But when you're playing the investment game, it's all about cash flow anyways. What about your home? It depends on the situation. You know, some people say it's all about the capital. So no, it's not. I have a client right now. They're about to have their second kid. They live in a 2-bedroom. Is that all about cash flow? Is that all about finances? No. It's that people need an extra room. Or else the baby's crib's going to be sleeping in the parents' house. Or the parents' room. House, room. Right? And that's only going to go for so long. So, yeah, there's a situational there. All right, maybe we need to sell, take the equity out of that to put it down on something a little bigger so that you can move on. And then we're afraid, because what happens if it falls? No. Remember, we're taking the equity that you built out of the 2-bedroom. We're going to put it down on the 3-bedroom. So we're not going to go take the cash and go to Aruba, right? Although that would be nice. No, we're not going to do that. We're going to be smart. We're going to buy this stuff down. We're going to make sure that we're paying attention. Some of that money was used, that one client I'm thinking of, some of that money was actually used to buy the rate down. So they know they got a rate in the low 4s, if I remember correctly. Even though rates were at 5s, they bought it down to close to 4. So they know now, 30-year figs, that's where they're at. Plus, they got a 3-bedroom. Plus, they got a bonus room. It's like a little office study, though. So if they decide to have another kid, they can just turn that into something. So there is not all financial. But at the same time, yeah, finances play a huge, huge factor in this. All right, there's your numbers. Like I said, I know this is a lot longer show than I normally do, but I had to debunk some of the myths floating around right now. I always end the show talking about our instant offer program. If you hadn't heard about that, that means that we can come out and give you an instant offer on a property. Usually that property is either inherited, needs a lot of work, they don't have time, capital to do the work. All right, they need to go. I had one needed to be in Texas in like 10 days because I got an awesome job offer in the Dallas-Fort Worth area and they had to be gone. But they didn't have the money to fix it. They needed a new roof. I mean, it was in horrible shape, but they had just inherited the property 2 years ago. So it made all kinds of sense. We made them an offer real quick. They were able to be out in Dallas. They walked away with some great capital to go handle stuff in Texas. I've got good contacts most everywhere in the country. You can't do this for coming up on 30 years and not have contacts all over the country. Plus, I do work with Remax, so there's a reason why that brand is so well. Anyways, if you want information about the Instant Offer Program, I do have a link below. Check that out. All right. Told you it was a little spicy this week. Thanks for watching. Have a great week.
I'm a man on a mission.
My mission is to help people break through all the noise out there and
Don't need no permission.
I want to help you get to actual truth. Don't you just want the truth?